Before you make your next move, you need to understand something because the rules of the game have just changed. On January 13th, the CME Group quietly flipped a kill switch buried deep in the market's plumbing, and almost no one is talking about it. I'm Eric with Summit Metals, and today in our metals market update, we're going to go deep into what's happening in these markets, how you should be thinking about it, and a proper way to position. Now, we're not financial advisors. This is not financial advice. This is for educational purposes. All right, let's get into it. The CME Group ditched the old system where margins were a fixed dollar amount and switched to a percentage of the total contract value. Now, in plain English, as silver jumps, the amount of cash you need just to hold a position automatically scales up with it. At a standard now 9% margin for silver, a standard that is almost $41,000 in collateral per 5,000 ounce bar. This is almost double what it was even a few months ago. So this isn't some conspiracy to crash the price. It's a proto-cyclical throttle designed to prevent clearing member defaults. Why? Because the exchange is terrified at how fast our silver is moving. Now, I can tell you from experience, having worked on Wall Street, I worked through the 1987 crash and others, and the way basically they're pricing these contracts now is consistent with the way we've always done it in the stock market. It's just completely shocking that they're now doing it this way as it relates to a futures contract. So this margin shock is forcing leveraged players to liquidate, creating these violent 5-10% daily swings, but you cannot liquidate your way out of a physical shortage. So today we're going to break down this great divorce of 2026 and more. Now, the reason the CME had to hit that kill switch is because the experts at the big banks have been living in a different universe. They were telling you that silver would average around $32 an ounce in 2025. They weren't just wrong, they were literally in the wrong ocean while metal tripled right below their feet. Now they are frantically updating their 2026 predictions because they are smelling the smoke. JP Morgan is now projecting that gold demand will drive prices toward $5,000 an ounce this year. Citigroup is calling for $100 silver by March, only a few months, even as they warn of massive rebalancing sell-offs. Bank of America issued a memo suggesting silver could peak as high as $390 an ounce if historic gold to silver ratios were to return. Goldman Sachs estimates that every 100 tons of central bank buying adds 1.7% to the price of gold. And central banks are currently on their longest buy-in streak in modern history. These banks are using jargon like programmatic mean reversion to explain why the price should go down. My translation, they're trapped in their own short positions and they need you to sell your physical bars so they can fill their holes in their balance sheets. They are looking at spreadsheets while the rest of the world is looking for real metal. Now, since January 1st, China, which as we know controls 60% of the world's refined silver supply, has implemented these new strict export licensing requirements. They move silver from an ordinary commodity to a strategic metal, putting it in the same league as our other rare earths. Under these rules, only 44 state-approved companies are even allowed to ship silver out of the country. Beijing is essentially weaponizing supply to secure their own domestic advantage in AI data centers, solar panels, and EV batteries. If you're a manufacturer in North America or Europe, you are now in a desperate scramble for the 30 to 45 days of accessible silver reserves left in London and New York vaults. This is why we're seeing physical silver in Shanghai trade at premiums over the price of the New York paper. The paper to physical ratio has expanded to a staggering 378 to 1. If even a tiny fraction of those paper holders demand their metal, the system faces a catastrophic short squeeze because the silver supply isn't there. Now, I want to talk about something also. You know, they're about to release out of the CME a 100-ounce contract. Here's what's important about it. It's not tied to physical. It's only paper and can only be settled in cash. That is, I think, very significant and something for us to pay attention to as we go forward. All right, now let's talk just briefly about BRICS. Why are BRICS making the moves now? And clearly it's because the U.S. debt clock is ticking, and no amount of accounting jargon can hide what's coming. Our national debt has surged past $38.5 trillion, and our interest payments alone now cost more than the entire national defense budget. The One Big Beautiful Bill Act signed last July is projected to add another $4.1 trillion to the debt over the next 10 years, or as much as $5.5 trillion. At this point, we've entered a regime of fiscal dominance. The government's need to keep spending and servicing its debt increasingly boxes in the Federal Reserve, pressuring it to keep rates lower than inflation-fighting policy would normally require. On December 1st, 2025, the Fed officially killed our quantitative tightening program because bank reserves were hitting a liquidity cliff. They pivoted back to buying $40 billion in short-term treasury bills every month just to keep the gears of the system grinding. This double pivot, ending the balance sheet reduction while cutting rates, is absolute catnip for gold. It's fantastic. Now, I know it's tempting to look at gold at 4,600 and silver at 91 and think, I missed it. But look at the positioning data. The commitment of traders' reports show that many managed funds and speculators are actually hesitant to chase these prices. They are still waiting on a correction that their computer models say has to happen. They are missing the move because they don't understand that silver is truly a strategic metal material with inelastic demand. So what's the move? My plan hasn't changed, but the environment of physical metal is becoming an awkward trade because local coin shops are getting buried under all of this volatility. Some dealers are actually declining to buy generic silver rounds because they can't handle the risk of the price dropping $10 before they can resell them. As we've mentioned here at Summit Metals, we actively hedge all of our positions as they come in, and that's why we remain open for your sell to us as addition to what we do on the buy side. Now, if you have American Silver Eagles or Gold Buffaloes, the coins of the realm, you still, of course, have options because that's what everyone wants when the plumbing starts to leak. We are in what I call like a wartime economy on commodities, where governments are hoarding strategic materials. The next 10 years are going to look very different from the last 40. You can either accept that and position yourself in hard assets that the Fed cannot print, or you can choose to be a victim of this currency decay. I'm advocating, don't let the mainstream media scare you with stories about index rebalancing. This great divorce is here, and eventually the digital price on your screen is going to have to reconcile with the physical reality in the vault. So stack what you want, keep what you have, and remember, if you don't own the real metal, you just own a bank's promise. And in 2026, those promises are getting harder to keep. That's our video for today. Please like, comment, and share. Thank you so much for tuning in, and happy stacking.